Technology is the latest sector to be affected by tensions between the U.S. and China.
The United States has to lead the world in producing these advanced chips. This law is going to make sure that it will.
Almost all of the fancy semiconductors in the world come out of Taiwan, and we really need that place to stay together.
Xi has been very clear that he thinks acquiring, invading, taking over Taiwan is his life goal.
The U.S. abuses export control measures to maliciously block and suppress Chinese companies. This practice deviates from the principle of fair competition and violates international economic and trade rules.
The U.S. CHIP Act is now starting to have impacts on Alibaba Cloud, and that's one thing that I'm going to try and cover in this video. So guys, as you smash that like button, let me run that intro. What's up guys? And this one's challenging because one of the major parts of our investment thesis with Alibaba is the fact that we expect the cloud business to grow out and continue to be profitable. Recall that the cloud business recently started hitting profitability, and so we want that to maintain and grow considerably. And as Alibaba starts to expand internationally, we want them to be competitive relative to their US competitors. And so this is very challenging news, as they're not actually able to get access to the chips that the other competitors like Google, like Microsoft, like Amazon would have access to. And the Financial Times recently put out a news article discussing how this is impacting Alibaba. And so let's dive right into that one. So you can see that the news report starts off by saying that Chinese chip designers like Alibaba are now slowing down processors to dodge US sanctions. And so effectively they're tweaking the specifications because, remember guys, the reason why they have to tweak those specifications is because these are fabless chip designers and they're relying on Taiwan Semiconductor in Taiwan to produce these chips, and Taiwan Semi is subject to the US sanctions, and so they have to gear these things down in order for Taiwan Semi to be able to produce them. Otherwise they're going to be banned from producing them due to US sanctions. Now the article goes on to say exactly what I just mentioned, that Alibaba startup Byron Technology is now tweaking their most advanced chip designs to reduce processing speeds to avoid US imposed sanctions aimed at suppressing Chinese computing power. And once again, like I mentioned previously, these chips are produced offshore by the world's largest contract chip maker, which is Taiwan Semi. Now, if you're unfamiliar with what these chip sanctions are, I was actually recently watching a news segment by Yahoo Finance, and they had an analyst on who actually discussed this in great detail. And so here's the analyst discussing it right now.
What Biden has done seems to be far more significant with far less fanfare. And the short version of this, it's very complicated, is a whole new range of what are basically embargoes on advanced semiconductor sales to China, and also any technology that China might be able to use to make its own advanced semiconductors. So one analyst described this as an intent to strangle with an intent to kill China's artificial intelligence industry. And this has everything to do not just with computers and technology, but it has a lot to do with surveillance, electric vehicles, and certainly with advanced weaponry. So the Biden administration is doing something here that really seems like it is going to put a stranglehold on part of China's economy, and China is probably going to retaliate in some way.
Now, of course, as you can imagine, as these sort of chip issues start ratcheting up and start impacting the Chinese economy, what exactly are the retaliatory impacts that could happen to American companies as a result of this? And so this is where I say that people who own shares in Apple, people who own shares in Tesla, you guys got to watch out. Now, this could impact almost every company that does business in China. So I'm not saying that just Apple and Tesla are going to be susceptible to potential retaliations. But what we have to do as investors is be aware to the potential of these risks. Now, I might just be overblowing this, and I generally do overblow risk, but it's just something to be aware of as we think about investing in Chinese companies like Alibaba. Now, I'm still going to hold on to my investment. I don't believe that these risks are going to be insurmountable, but it's something to consider as we move forward with our thesis. So here's that analyst on the potential of retaliation.
Some of the things they could do would be making life hard for U.S. businesses operating in China. There are many American businesses that want to sell to the Chinese market and do sell to the Chinese market. I mean, think about Tesla and Apple, for example. They could also restrict sales to the United States of things like rare earth minerals. There are some such minerals really important to technologies of the future, that China has kind of has a corner on the market. So they could do that, or they could do subtler things, and they could also file a complaint at the World Trade Organization, which would take years and years to resolve, as is usually the case. So this is going to be very interesting for a long time to come.
Now, I don't know if there's going to be an escalation in conflict, but if I'm a betting man, I don't think it's going to happen. I think Joe Biden and President Xi Jinping are trying to push, or at least trying to angle publicly, that they're trying to work together and have everyone work together. And they did just meet earlier this week, and it looked like the meetings went very well. Here's President Joe Biden making a statement at the meeting itself.
As the leaders of our two nations, we share responsibility, in my view, to show that China and the United States can manage our differences, prevent competition from becoming anything ever near conflict, and to find ways to work together on urgent global issues that require our mutual cooperation.
And it looks like the meeting went so well that even the Western media, if I'm going to be honest, tends to be a little bit negative about the US-China relations. They even were swooning over the fact that they believed that the meeting went well. So from my perspective, that's what I'm using to gauge the fact that relations will probably be okay. I don't think that there's going to be an escalation. I don't think that there's going to be sort of like a Cold War, but you never really know. Hot one day, cold another with respect to the US-China relations. And so here's one clip of the media talking about the meeting.
And I think what we should read from this meeting is two old pros whose teams know how to pull off a good meeting. They had a number of lower level meetings beforehand. They had contacts between the ambassadors, between Kerry and his counterpart in Egypt. The best thing about this meeting is that they arranged for lower level people to meet afterwards. That's really important because presidents don't have a lot of time to get to visit with each other. You need that knitting together of the teams to do that.
So it looks to me like the escalation is pretty much off the table. I don't think it's going to happen, and that's good news in my opinion. But you guys let me know what you think in the comments below. But I don't believe that there's going to be any scale backs to that chip legislation that was passed by the US, and so it still looks like this is going to impact Alibaba, at least in the short term, and I don't see any sort of give on that legislation to allow China to have supercomputing power. And so what does this mean for Alibaba? That's the main point of what I want to get at this video. Well, you can see now we're back in that article. What they're saying is that you kind of have to be low key now. This is what a rival of Byron said, and of course Byron is the chip designer owned by Alibaba, or at least Alibaba has a stake in them. And they're saying that Byron has done way too much PR and their specs are out there in black and white. So now it's difficult for TSMC or Taiwan Semiconductor to help them find a way out. A person close to the Taiwan Semiconductor group said that Byron's public presentations touting its processors has forced the contract chip maker to halt supplies because the chip's performance probably met the specifications banned by the US restrictions. And so now you're in a place where Byron has to begin to tweak its designs and reduce processor speeds in hopes of getting them manufactured by Taiwan Semi. And here's where you run into a little bit of a weird situation, because they're not actually changing the chip design, or at least it's being reported by Financial Times that they're not actually changing the chip design. And so what they're really doing, and I highlighted here in red, is sort of like entering into a pinky promise with Taiwan Semi that they're not gonna enable part of the processor that they sort of disable. And so the risk here is if the US regulators come and take a look at this and say, nope, these chips are too powerful, and so that whole business unit gets destroyed. And so this here is Alibaba's presentation from their investor day last year, and they did tout their chips and their sort of cloud servers. Now, based on the information that's provided, at least in this slide, you don't really know if these chips are going to be too fast for the regulations or not at all. But the point that I'm making is that Alibaba was front and center about boasting or making public disclosures about how fast their chips are. And so one of the things that we have to look forward to in the Alibaba Investor Day is specifically on their cloud segment and how they're sort of addressing this risk. And I really hope that they speak to it, because what I want to hear as an investor is that yes, the US sanctions have impacted the business, but these are the steps that they're taking to get around it to not slow down the growth of the business. Now, Alibaba Cloud has already slowed down, and I'll show you in a slide later in this video where I have actually brought down my growth expectations for Alibaba Cloud, which is crazy because all of the other competitors, I expect their growth to be around 20 to 25%, but I've slowed down Alibaba to around 15% for their cloud segment. And so it's tough. And what I'm really trying to get across here and really hope that the management team does is provide us disclosures on why we should be thinking about the Alibaba cloud business growing faster in spite of the elevated competition from the Chinese-owned companies and, of course, the speed bumps coming from tighter US regulations. And so now let's get into a little bit more of the meat and potatoes of this video. So you can see here, I want to show you guys a slide from their Investor Day. Now, if you haven't checked out their Investor Day materials from the 2021 Investor Day, which of course was last year's Investor Day, I highly recommend that you do check it out. Now, I did a 10-part video series on their Investor Day, and I will actually link video number 1 to the end of this video. And so you can actually just watch all 10 videos of their Investor Day and get a full thorough analysis from me on all of their presentation materials that they put out on their Investor Day, and I added a lot more material to it. So I'm very thorough in that, and I will do that again this year. But what I want to show you is a slide from their cloud computing presentation. So if you decide to grow Alibaba cloud segment revenues near their 5-year CAGR for the China market outlook, you'd have to grow it at around 37%. And so that's their 5-year CAGR from 2020 to 2025. Now, I think a lot of people were doing this initially, but you kind of have to back off from that because although I don't think you'd be wrong if you use that, I've become very conservative. There are risks with the cloud business in China, and I've talked about many of them. But the one risk that I do want to mention in this video at least is demonstrated pretty perfectly with this McKinsey & Company presentation deck that they put out on the Chinese cloud business. So you can see that they expect the private cloud to grow at the same speed as the public cloud business. But here's the problem that I'm running into. It's uncertain how much annual growth the state-owned cloud providers will gobble up from the private enterprises. McKinsey is basically saying that the growth is going to be equal. I don't think so. And so you got to worry about companies like Alibaba Cloud, and I think it's prudent to remain conservative until proven otherwise. I am eagerly awaiting for Alibaba's cloud's management to discuss this risk in their Investor Day presentation as well. They may not discuss this one because this relates directly to the CCP or like state-owned enterprises as well. And so they may not touch on it. And so we might need to go to third-party information or data sources to sort of understand this risk better. If more and more companies are choosing to go with state-owned cloud providers, Alibaba could run into an issue even though Alibaba has the better product. And so I really don't know how to think about this. Guys, you guys always let me know great sources of material to learn more about this. So let me know, link whatever you guys got that provides me a little bit more learnings on this topic. Let me know in the comments below. And here's what you can see from my model that all the Patreons get access to at that lower tier of the Patreon. I've priced it super low at just $5 a month. And essentially what that's doing is you're just buying me a couple of coffees for getting access to all of the research that I personally use to make my own investment decisions, but never use my research to make your investment decisions, and also always talk to an investment advisor. But notice here that the cloud business historically has at least been growing at 20%, but before 2022, notice that the lowest amount it ever got to was 50% year-over-year growth. And so that is starkly in contrast with how I'm growing it out in 2023 and beyond. So you notice that in fiscal year 2023, I'm only growing the Alibaba Cloud segment at 10%. This is top line revenue, guys. And then in fiscal year 2024 and beyond, I'm only growing it at 15% a year. So what I'm really saying here is that I'm growing it at less than 50% or less than half of that 37% CAGR growth rate that they're providing to you guys in their Investor Day presentation. So that's how conservative I've become on this segment. Now, I don't really know how to think about profitability either. I think in this environment, if there is a recession, you might dip into a negative adjusted EBITDA once again for the Alibaba Cloud segment, but I'm more focused on the top line growing. And so I'm really hoping for more information from them on this segment to gain a little bit more confidence, because the only direction that my confidence has been going on Alibaba Cloud is negative, and so, or downwards. And so I'm really hoping for something to come out here. But that being said, I'll show you guys a valuation in a second. I'm still an Alibaba shareholder, and I've absolutely committed more capital to this investment in this environment. I do believe that ultimately we're going to make money here. But despite that, I'm not just a blind cheerleader. I will always point out the negatives in these investments. Now, guys, the other thing that you got to pay attention to is the fact that growth in China is starting to slow, and there are analysts that are talking about this, and this will absolutely impact our valuation. And so here's Raymond Young talking about growth slowing in China and why growth is slowing, because it seems to be like the CCP is focusing on a specific type of growth. Here's that analyst talking about it.
How much would you say that growth in China is now taking a back seat to other priorities such as national security?
Yes, I think Xi Jinping made that clear that he put high quality development as the top priority. We all know that they didn't even bother to release the GDP last week. It can tell us that how much emphasis they are on this very important economic number, not just to China, but to the rest of the world. But of course, we do project that the GDP number will be slowing down in terms of growth. We're looking at 3% growth in the third quarter and for the full year of this year as well. And next year, we're looking at 4.2% growth in 2023. And I don't expect that China will go back to the period of 5% growth anymore over the next few years, unless they have a significant improvement in total factor productivity and able to address all those difficult challenges, including demographics and also geopolitics as well.
Now, the other thing that I do want to point out to you guys is that growth is expected to slow for the Chinese economy as a whole. Now, you can see 2020's growth was 2.3%, but that was impacted by COVID. And you can see that 2022 and 2023, you're now under that 6% rate. That's sort of what people are expecting. So how should we really be thinking about China commerce growing? So you can see that, from 2016 through 2021, the China commerce segment grew at approximately 40% a year. That was pretty standard. And this is how people were valuing Alibaba at approximately $400 or $500 per share. But now look, in 2022, it's slowed down to 18%. And actually, in 2023, I'm forecasting that China commerce actually goes backwards. Now, I might be a little bit too conservative here. I'm forecasting the segment to go back by 7.5%. Thereafter, in fiscal year 2024 and beyond, I'm forecasting this segment to grow at 7.5%. So, is that a little bit too conservative, or is that slightly too optimistic? Well, it just depends on what you think about their GDP. I think the GDP growth estimates will get revised a little bit higher. I think we go back to around that 6% range. And so I think total China commerce grows at around 7.5% a year. But I might be wrong, but overall, you can see that total revenues are growing at approximately 8%, 8.5% a year. And that's what I'm factoring in to my valuation. But what exactly is my valuation? Now, before we go into the valuation, I just got to remind you guys that approximately 80% of the watch time on this channel is from people that are not subscribed. So please, if you have the chance, hit that subscribe button. Now, let's dive right into my valuation. You can see that just using a terminal multiple of 15 times earnings and that very slow revenue growth, I'm still valuing the company at over $200 per share. If you compare that to their current share price, it's trading at approximately a third of its intrinsic value. Now, the other thing that I want you to know is compare that excess cash number, which is at $41.44, to the current share price. So approximately 2/3 of the share price is cash or excess cash that they have on their balance sheet. And they're absolutely buying back ADRs. And I expect that within the next 12 months or so, they're going to increase that share repurchase authorization because they're going to run out as they've been buying back so many shares. But we'll see how that plays out. This is a bit of a speculation on my end. We'll see what they end up doing. Do they slow down buying back shares in this environment? I don't think so, because the shares are so low that it's incredibly accretive if they're buying it back in this environment. Now, guys, earlier I talked about the 10-part series that I did on Alibaba's Investor Day last year. If you missed it, or if you want a refresher on a total walkthrough of all the segments in an incredible amount of detail, I've actually linked that series right here.